So let's now have a look at learning objective 1. Describe the recording and reporting of receivables. So as I mentioned in the introduction today, businesses run in many cases on credit, right? So some of you might think that when you go to a supermarket or a department store and you buy with your credit card, that organization is offering you credit and finance. But that is not actually the case. So we're not looking at those type of transactions today. So when you go to a retailer and you pay with a credit card, usually that retailer will receive your money within 24 hours. You then owe that balance to your bank or your financial provider. So the financial provider pays your supermarket, the store you purchase from, within 24 hours typically, and then you need to pay that money back to them directly. So for example, if we go on and we have a look at Aldi's website and we see their methods of payment, they accept Visa, MasterCard, Discover, American Express, etc., and other forms of payment. So Aldi doesn't offer direct credit to their customers. They accept different methods of payment, and they get payment, for example, from your bank via your credit card payment within 24 hours of accepting that transaction. Now, of course, banks take a cut of these transactions. So therefore, Aldi, Coles, Woolworths bear a cost of accepting credit cards. But remember, they don't actually need to offer their customers finance directly as a result of this, and there is efficiencies and there can be a cost saving associated with that. And we're going to look at some of the costs of extending credit to customers as we move through today's workshop. And so what will become clear to you is that in some cases, it is more efficient for the retailer to delegate the finance offering to an outside provider, like your bank, credit card company, etc. So, what we're essentially looking at today is receivables. So a receivable represents a business's claim on the assets of another entity. And so the most common type of receivable is an account receivable. So that's an amount owed by a customer who has purchased the company's product or service. Now, what is important here is it says a receivables represents a business's claim on the assets of another entity. So by issuing credit to a customer, essentially the business that issues that credit therefore has the rights to the asset that they have given the customer on the basis that they've financed that particular asset. So if the customer doesn't pay, that would essentially give the retailer the right to take that particular product back to service the credit that they owed the customer. So for example, if we turn to Gray's, which is a large auction house that has sites across Australia, they have listings here for repossessed items. So this is a Sydney repossessed car auction. These cars are all online, available for you to bid on right now. These cars have been taken off people that have failed to meet the repayment schedule of these vehicles. So the finance provider has sent out a repossession company to remove these vehicles from the owner's possession, and they are now reselling them to recover the amount that is owing, essentially. So some of you might have seen shows on television like Operation Repo that essentially act out how they repossess these items and take them away from the customer so that the finance provider can recover, hopefully, most of their money, all of their money, or maybe some of it, depending on the condition of the item they have repossessed. Although we can see some of these here aren't going for amazing prices, but there's still time ticking away. So if we move on and look at the consolidated balance sheet for CSL, which is the company in your textbook, we can see that they report their trade and other receivables in their balance sheet. And you can see that their trade and other receivables in the year ended 2017 were $1.17 billion, which is a little bit more than their year ended 2016 amount. So obviously a very, very significant amount, suggesting that their customers do expect that CSL extends them credit and finance in order to buy product from them. Now, of course, we also see down the bottom here that CSL owes other organizations, so trade and other payables, $1.155 billion. So this is essentially equivalent to the credit that CSL has received from other companies in terms of buying their supplies, inventory, etc., that they've used to manufacture and retail the products that they are selling their customers. So today, obviously, we're looking at how we generate information related to trade and other receivables, as well as accounting for the cost where a customer does not pay up as required. So if we look at this particular scenario, it says on June 4, Chen sells $1,000 of product to a customer on account. So that is on credit. So this is where we're selling something to a customer and the customer is agreeing to buy later. So the question that I have for you right now is, what journal entry is required in this case? Is it no journal entry because no cash has been exchanged? Do you debit accounts receivable and credit sales revenue, or do you do vice versa and debit sales revenue and credit accounts receivable? Please answer this question now. Now, if we look at the answer to this question here, what you can see there is that Chen sold $1,000 of product to the customer. So remember, we looked at the revenue recognition principle, and the revenue recognition principle says that you recognize revenue when you earn it. So if Chen has delivered as promised to the customer, then of course Chen has earned $1,000 in sales revenue. The customer obviously has yet to pay because Chen has extended credit to that customer. So essentially, Chen expects payment at some point in the future in the form of $1,000 in cash to settle up on this amount that is owed. So because we didn't receive cash, we received something else, which is a commitment from the customer in order to pay $1,000 at some point in time, and we reflect that by debiting accounts receivable. So this is an asset to Chen because this is the asset and expectation that we will receive $1,000 in cash at some point in the future. So the correct journal entry in this case is debit accounts receivable and credit sales revenue. So there's really nothing new there. That's applying the same rules that we looked at in terms of how we debit and credit different accounts. So remember, if you're still having trouble remembering which accounts you debit and which accounts you credit, then you need to get out your trusty piece of paper that I showed you before, the STUVAC, where you have assets plus expenses equals liabilities plus equity plus revenue. If you want to increase the asset and expense side, you debit. If you want to increase the liabilities, equities, revenue side, you credit, and vice versa to decrease. So remember, I'm assuming you know this now. So if you don't, you really need to get on top of this and remember it through referring to the equation and remembering the debits and credit effects. So let's move on and let's have a look at some new themes and content for today. So let's have a look at complication 1. What happens if a customer returns a product? And if you go to a retailer on Boxing Day, what you will typically find is there's a lot of customers that are lining up to get in for the sales, although I'm not really sure why, because you can get the sales online in most cases and without the hassle of actually going to the store. You'll find people lining up to get in to get the sales, but you'll also find a lineup of people at the returns counter returning things that they don't want. And so we need a way of accounting for this issue and dealing with this in the context of accounts receivables that we've recorded. So let's have a look at this example. On June 10, Chen has returned to them $150 of products that were the wrong color. So that basically means that customers have returned $150 of products to Chen because Chen must have distributed the wrong color of product to the customer. So filled the wrong order requirements, essentially. So what we need to do in this particular case is we obviously need to wipe out the accounts receivable that was associated with this sale. Because if the customer returns $150 worth of product, then of course they no longer owe us this particular amount. So we credit the accounts receivable account to get rid of that accounts receivable. The other thing that we need to do here is we need to obviously reduce our sales revenue because we have no longer earned that sales revenue because the customer has returned back to us the product that we originally sold them. And so what you'll see that we're debiting in this case is an account called sales returns and allowances. Now, this is an important account because it allows us to analyze how effectively a business is meeting its commitment to customers. So if you look at an income statement and you see a large balance for sales returns and allowances, that is suggesting obviously a large proportion of customers or a large amount of customers are returning a lot of different products, which of course could be a point of concern. So the sales returns and allowances account is a contra revenue account, which means that in your income statement, you have your sales revenue, you minus your sales returns and allowances, and that gives you your net sales revenue. So essentially what we want to do is we want to debit any returns to this sales returns and allowance account so we can capture that additional information. We can look at how that contra account, so sales revenues and allowances, how that affects sales revenue and therefore giving you a net balance of sales revenue. So let's have a look at complication number 2. What happens if a business gives a customer a discount on a product post-sale? So some of you are going to think, well, this is very unusual. Why would a business give a customer a discount post-sale of that product? Well, there's good reason for this. So businesses obviously want cash sooner. So the question is money worth more today than it is tomorrow? What do you think? Well, yes, it is worth more today than it is tomorrow because today you can take your cash, you can invest it, you can earn interest on it, or you can pay off loans and therefore save interest payment on those loans. So a lot of businesses, when offering their customers finance options, they will of course offer them a discount if the customer pays early. That's why in many cases, if you go to buy something and you offer a business cash at the time of purchase, they will give you a better price for that product because they're getting the money immediately. They don't need to chase you for the money, and they can use that money immediately to essentially save themselves financing costs and make themselves more interest if they bank that money immediately. So in this particular case, Chen grants these credit terms to the customer. So the credit terms are 2/10 and N/30. So what does this all mean? Well, the first part here, 2/10, means that if the customer pays within 10 days, they get a 2% discount. If they pay within 30 days, they pay the net balance. So that means Chen is encouraging the customer to pay in 10 days by giving them a 2% discount within that 10-day period. If the customer doesn't pay in 10 days, then they need to repay the full balance within 30 days. That's all those terms mean there. So on June 12, the customer pays the remaining $850 bill. So what we can see is if we go back to the original scenario, which is Chen sold this customer the product on June 4. From June 4 to June 12, that is less than 10 days. So that means the customer receives a 2% discount for paying earlier. So they receive that discount. So how do we account for this? Well, the thing we need to look at first is the fact that the customer is completely settling up on the amount that they owe Chen. So remember, in net terms, they've now purchased $850 of product. So if we go back to the original transaction, the original sale was $1,000. The customer then returned $150, which leaves $850 owing. Now, based on this $850 that's owing, the customer is paying for it within the 10-day period. So they only pay $833 in cash. The remaining amount is the sales discount, which is equivalent to 2% of the $850 that the customer owes. So we debit the sales discount account, which is another contra revenue account, which means when you look at your income statement, you see your sales revenue minus, if we go back to the previous transaction that we looked at, the sales returns and allowances, and also minus the sales discounts extended to customers post-sale. In this case, this is $17. So after deducting the sales returns and allowances and the sales discount from your gross sales revenue, you get your net sales revenue figure, which is obviously the final sales revenue figure in net terms that Chen has earned from the customers. So by looking at this account in total, we're getting a reflection on how much discount Chen provided to customers in order to get them to pay earlier. Okay, so looking at this in a bit more detail, these are the credit terms, as I mentioned to before. These boxes here explain to you the calculations that we've just looked at. So remember I said if the customer pays within 10 days, they get a 2% discount, right, which is reflected here. If they don't pay within 10 days, they have to pay the total balance, $850 in 30. So 2% of the amount owing of $850 is equivalent to $17. Now, a question I have for you now is, what does this mean? What does 4/15 n/60 mean? So if you can select what the correct answer is right now, and then we'll have a look at what is the answer. So the easiest way to read these credit terms is start from the beginning. 4/15. First thing, 4% discount in 15 days. 4% discount in 15 days. Net amount in 60. Total due in 60 days. Right? So that's how you read it from start to end. 4% in 15 days, net in 60. So the correct answer here is the first one, 4% discount in 15 days, net due or total due in 60 days.